Welcome to the Real Estate Espresso podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menasce. This is the weekend edition where we interview notable people from the world of real estate investing. Today is no exception. We have a great guest all the way from Columbus, Ohio. Welcome to the show, Chad Ackerman.
Thank you very much, Victor. Really happy to be here. Excited about the conversation.
Well, great to have you here. You and I have crossed paths before when you were in a past life, and keen to have this conversation. You've got some interesting things going on, but maybe for the folks who haven't met you yet, perhaps give a bit of your backstory and how you got to this point in your journey.
Yeah, sure. The quick and dirty, I was a corporate guy for 25 plus years and discovered one day that I was leaning on my one paycheck as my whole lifeblood for my financial situation, and discovered the real estate investing world and chased a lot of shiny objects and wasn't quite sure where to apply myself until I found the passive investing side, and I leaned in heavy and I started investing, loved it. Group I got connected to locally, we decided to start a meetup group that our first meeting got canceled by COVID. And so we became an online company instead. And that let us grow to where we grew it into what was known as Left Field Investors. We had the luck of having Y Street come on and I think share at least a lunch and learn with us.
That's right.
Which was great. And we grew that for several years and ended up selling to Passive Pockets or Bigger Pockets, and it became Passive Pockets. Then I went out, got certified as a business coach, and I've blended my experience with Left Field and as an individual investor myself together with the coaching. And now I try to educate people that have an interest in learning about this space on how to get started, how to build their confidence, how to build some foundation work to get them deployed in this passive investing world.
It can be a little bit of the Wild West out there in many respects. And one of the things we've seen, especially over the last, 4 or 5 years, everything in 2020 and 2021 looked like a deal. And the numbers in Excel looked amazing. They just didn't quite work in the real world. And a lot of folks, even very experienced folks, made investments that probably were not solidly underwritten. And from your past work in Left Field, your team did, I think the term was deep due diligence, triple D,
That's right.
We've experienced. We've had a number of conversations with the Left Field team and Passive Pockets team, and we actually have some of the folks from the former Left Field as investors in our projects, which is awesome. And what I love about that philosophy is that the investor actually takes an interest in learning what the project's about. I mean, it makes me sick to my stomach when an investor, a passive investor, takes an offering memorandum, signs it, and it's obvious they haven't read it. I mean, we're not doing anything wrong as a developer, but oh my gosh, please read it. Please read it and understand it. And often they don't. And they're taking risks that they're completely unaware of.
Yeah. We call it passive investing, but our term in Left Field and what I still use now with CARE, you're an active passive investor. You need to do your due diligence before you ever sign that document and write the check. Once you do the writing the check and the signing of the documents, then you could become passive and just collect the communications and distributions, and that's fine. But you need to put some work in up front for sure. And that's a lot of why I built the education program that I did, to help people understand that it isn't truly, I just hand my money to somebody and I think it's going to be okay. You need to know, like, and trust that individual. And you need to, not only that, have your goals set before you decide who you're going to invest with. Asset classes operate differently. So if you don't know what you really want out of your investments, you may deploy your capital in a direction that you really aren't trying to utilize as a goal. And then you'll get frustrated because it's not producing the way you think it should. So what I try to do with my business is slow people down and back them up. They get excited. I get it. It's an emotional experience. They get excited. I try to slow them down, get them focused on the foundation stuff first so they can deploy with less emotion and more get into black and white is what I try to do.
When we evaluate anything ourselves, and certainly when we speak with institutional investors, of which we regularly speak with, there's 3 pillars that we look at. There's the submarket, there is the team that's executing the project, and then there's the specifics of the deal. And you kind of need to underwrite all 3 of those almost independently. And you often, in the world of registered investment advisors and FINRA licensed broker dealers. There are these organizations that all they do, folks like FactRight, Mick Law, that will create a due diligence report for the investors up front, where they've literally crawled through the project, crawled through the details of the sponsor, and written an independent third-party report for the investor before the investor even looks at the deal. And yet, how many times do I see an investor spend more time evaluating which toaster to buy in the aisle at Walmart than they do on the, it makes me crazy.
Mm-hmm. Yeah, I would agree. I don't know if it's still as abused today. I think when I started investing was 2018, and that was a very hot market. And I think it was easier for LPs to do that then because operators couldn't miss almost because of the economy, because of the market driving the results, not good operating. And then the gut check came with COVID and then the interest rate change and insurance change that the LP needed to recalibrate. I say this often, like there were expectations set way too high based on how the 20 teens ended up from a performance standpoint, that people got lazy because the expectation was there that we were going to get high 20 IRRs or 30% IRRs. And that was the new norm of what we could expect. Well, no, we slipped out of the norm into a very aggressively positive performance mode for several years there at the end of the teens. And now we're back to probably more substantial long-term expectation kind of levels that the LP needed to kind of bring down their expectations and be okay with 12%, 14% IRRs. It's still a good, solid investment and hopefully a little more reliable than what it was 3-4 years ago when people were getting caught having not underwritten their deals properly left and right, it felt like.
Oftentimes when an investor is looking to put money to work, they might think it's their money, but often that's not true. Often it's actually the family's money. And they have certainly a moral responsibility, if not a fiduciary responsibility, to make sure that the spectrum of interests in the family are respected. Because at the end of the day, I call it the 4 buckets. There's your safety bucket. This might be the money that maybe the gold coins under your mattress that are untouchable. And then there's the cash flow bucket that feeds your day-to-day. There's the growth bucket and maybe a risk bucket. And so then the question is the investment that you are evaluating, is it in fact appropriate? Have you even gone through the thought process from an asset allocation standpoint to make sure that what you are doing in fact aligns with that quadrant, that it belongs in the portfolio? And often folks don't, they may paint themselves and say, I'm a cash flow investor. Well, okay, you are for that quadrant. But nobody is just one of those 4, right? You really should have all 4 of those. And how does that fit in the context with the work that you do?
Yeah, no, that is a lot of what I try to educate people on, of understanding that diversity should be king in all of this. And I'm not a financial advisor, so I have a limit to what I can talk to them about. But part of the discussion will be you should go see a financial advisor and figure out how this plays in your portfolio. But I call it investor identity. It's spending time talking to you up front about what is your risk profile? What's your time frame that you're really looking at? What other investments do you have and how are you spreading this around? We called the passive investing in real estate left field. We called the stock market right field. We said that you really ought to be in center field, probably is where you should be. So I try to have those conversations with people to help them understand that, yeah, there isn't a one size fits all. There isn't a one answer is better than the other. The ultimate answer is, I always say, treat it like your will. You should create your will for what you need today. And then as your life changes, pivot your strategy to align with what changed and make adjustments to your portfolio as you can, as money comes available and so forth. But don't try to build your portfolio today for what you need 10 years from now. That could be dangerous. Figure out what you need today or what you're trying to do and how that may incorporate into getting you to where you need to be 10 years from now, but be able to pivot and be agile with what you're doing as well. All the kind of things I try to bring up to people. This isn't a set it and forget it and repeat the same process for the rest of your career doing this. You do have some due diligence you need to do of your own on your own strategy to make sure you're staying aligned.
100%. And if you're too far off center, you quickly get into foul ball territory.
Yeah. Yeah. And then it feels awkward and you get frustrated and you think it doesn't work. And then you leave the industry and you give up on the space. And that's where I really hate to see people that get frustrated and walk away. And it's like, well, maybe you're frustrated because we had bad alignment and the bad alignment led to that. Let's clear up the alignment early on so that you don't hit those bumps, at least minimize them.
Love it. Well, Chad, this is great. If folks want to connect, if they want to learn more, what's the best way?
Best way, I've got a starter kit that I offer out to people out on my website under chadackermanrealestate.com/start. chadackermanrealestate.com/start again. Go out there. You can find me. We can get together. You can book time with me, or you can find the starter kit and just get some information and see if it's for you.
Terrific. Well, Chad, great to connect as always. And for the listeners at home, definitely reach out to Chad Ackerman at chadackermanrealestate.com. The links will be in the show notes. And in the meantime, have an awesome rest of your weekend. Go make some great things happen. And we'll talk to you again tomorrow.